This is Ray Dalio, founder of the world's biggest hedge fund firm, Bridgewater Associates, managing $160 billion for his wealthy clients. Now, obviously, he's another legendary tier investor who reached the highest ranks together with all the other investing gods like Warren Buffett, Benjamin Graham, John Bogle. So whatever he says, you should try and listen. And recently, he gave a very dark warning to investors, saying that there's a possible lost decade coming up. Hi guys, welcome back to my channel, Kelvin here. In this video, I'll be telling you what is a lost decade, what is causing it, and how you can prepare for it. There's a lot to talk about, so let's jump right in. If we look to the past, there have been many times where the stock market delivered zero or negative returns over the long term. And by long term, I do not mean 1 or 2 months. It can be 10 years, 20 years, or even more. If you look at S&P 500, the most recent lost decade is during 2000, which happened during the dot-com crash. So if you were to invest in the S&P 500 during that time, you will have to wait 13 years before you see any positive returns on your investments. That's what a lost decade is. A few more examples, from 1929, which was the start of the Great Depression, all the way until 1961. You'll be seeing a loss on your investments. Japan's Nikkei index peaked in 1990 and has been basically down all the way till now. Europe peaked in 2000 and has been trading sideways till now. Or even Singapore, which has been trading sideways up till now. The market is like, oh, I'm going up. Nah, just kidding. Going up again? Nah. So these are just some of the examples of lost decades. Despite what you may think, stocks do not always go up all the time. But why Ray Dalio thinks that there's a possible lost decade ahead? There are 2 reasons. First, he feels that there's a possible reversal of strong growth seen over the years in US corporate profit margins. As we all know, starting from 2009, the S&P 500 has been partying all the way up to 2020, enjoying the best bull run ever, before the pandemic came along and said, stop this. Now, all this strong growth is due to the result of globalization, where countries will outsource their production and manufacturing to other countries like China. They do this because it's much cheaper to produce stuff overseas, leading to higher profit margins and earnings, leading to bonus for everyone. But Ray Dalio thinks that globalization will decline because of 2 reasons. First, global pandemic and US-China conflict, with all the trade wars where you tariff me and I tariff you. Many companies will prefer to shift their operations back to United States, preferring to focus on reliability instead of just cost optimization. For example, Intel and Taiwan Semiconductor Manufacturing plans to build their factories in the US despite the higher costs. Intel said, we are very serious about this, even though Joker said, "So not so serious." So that was the first argument for a possible lost decade, deglobalization leading to lower profit margins. The second argument is higher corporate debts. The pandemic caused countries to shut down their economies. Businesses were forced to close, which leads to lower spending, which leads to huge fall in profit margins for companies, which leads to no bonus for everyone. Even if profits recovered, some companies will die or shares devalue along the way. Left with lower levels of profits and cash shortfalls, companies will come out on the other side of the pandemic more indebted. Because when businesses can't operate for months but still have bills to pay, they will be forced to borrow more money, which will lead to higher corporate debt. And higher corporate debt is never good for the market. So those are the 2 reasons why Ray Dalio thinks that a lost decade is coming: deglobalization and higher corporate debt. And when he goes all Eden-like and say, you are not prepared, it's something that you should take note about. So let's look at how Ray Dalio is preparing for this by looking at his portfolio, also known as all-weather portfolio. As the name suggests, this portfolio can weather through any weather. Or in other words, this portfolio will perform well in both good times and bad times. Let's take a look at the almighty all-weather portfolio. First, he has 30% in stocks. Stocks will do well when the economy is well, like during the bull run from 2009 to 2020, S&P had ran up 300% in just 10 years. On average, it's 30% per year. Incredible, right? However, stocks are very volatile. It can run up very fast and drop very fast. Just like S&P from 2000 to 2002, where it dropped by almost 50%. So, to reduce the risk, bonds are introduced into the portfolio. 40% long-term bond, 15% intermediate bond. That's a little more than half of its portfolio. Bonds won't give a high return as compared to stocks, but it will give a fixed income when times are good and times are bad. acting as a defensive item for your portfolio, like plus 100 volatile defense. Third, 7.5% gold and 7.5% commodity. Gold and commodities will do well whenever there's inflation. For example, when times are bad, people will move their money into safe havens like gold. The idea of this portfolio is that by building 4 uncorrelated asset classes, it will perform well in different market conditions. Rising growth, which favors stocks and commodities. Rising inflation, bonds, commodities. Falling growth, bonds. Falling inflation, stock and bonds. Compare that to if you just have stocks, where you will only do well during rising growth period and falling inflation period. Sounds good? Now, how has this portfolio performed in the past? If you look at lazyportfolioetf.com, the all-weather portfolio has been producing 7.8% annualized over 10 years. Tony Robbins, a motivational speaker, also backtested the portfolio and said that he made money more than 85% of the time between 1984 to 2013, during which there were 3 recessions: early 1990s recession, dot-com bubble in 2000s, and the financial crisis 2008. However, even though this portfolio is good, I'm not a huge fan of it because I think that it is overly defensive. It's like playing football. Instead of having 1 goalkeeper, you have 11 goalkeepers. And when your opponent is unable to score, they will go, "I want to play football." By playing defense, sure, you will not lose, but you will not win either. Don't get me wrong, this portfolio is good, but it's not good if you have a long-term horizon like 20 years or 30 years, in which you can potentially get a much higher return. So, the all-weather portfolio is more suited to capital preservation rather than capital growth. With that being said, I would totally consider this portfolio if I were nearing my retirement, where I prefer stability and cannot handle the market going up and down 10%, which might cause me to have a heart attack, literally. To reiterate, the all-weather portfolio, which was designed by the biggest hedge fund manager, is good for the lost decade, but not good enough for me, a low subscriber count YouTuber who is still learning how to invest. That means you should not blindly listen to my advice, but instead, tap the like button to help support the channel. So here's how I will prepare for a lost decade instead. First, dollar cost average. Dollar cost average is just continuously buy every period, so that over time, you will average out your purchase price. Let's relook at the S&P 500 chart. This here is a lost decade, right? If you were to invest here, you will have to wait 13 years before you can get a positive return. But if you were to dollar cost average and buy every month instead, your average price would have been much lower, and you wouldn't need to wait that long to get a positive return. Newbie investors will be like, why don't you time the market instead? Don't buy at the high lah, just wait for the crash and buy at the low points. To which I reply, unless you are a god of stocks like Warren Buffett, you will never be able to do it. In fact, Warren Buffett himself couldn't time the market, having bought airlines during the March crash, but quickly sold out just a few weeks later. Charles Schwab found that timing the market has a risk, which is if you time the market wrongly, you will miss out on the best days in the market, and will be much worse off than dollar cost average. So never time the market guys, just dollar cost average. Second, invest in dividend stocks. The way a dividend stock investor earns money is different from a growth stock investor. Dividend investors earn money from dividends, while a growth stock investor relies on stock price increase to earn money. So if a lost decade happens, the growth stock investors will be like, uh-oh liao, you will have to wait for a few years before you start earning anything if you are lucky. But if you invest in dividend stocks, if the stock market goes up, you get paid. If the stock market goes down, you get paid also. Essentially, you are immune to stock market fluctuations. You'll be like, huh? What is stock market fluctuations? 可以吃的吗? On top of that, dividend stocks have the power of compounding. When you reinvest your dividends back into the stock market, your investments will grow at a much faster rate. So, invest in dividends to get a steady income. Since Ray Dalio warned that the US market may experience a lost decade, what's the best way to avoid it? Don't invest. You won't experience a lost decade if you don't invest. Just kidding. Instead, you can diversify your investments globally. Invest in China companies like Alibaba, Tencent, or even China ETF, IHS MSCI China. With China buying other countries' debts and the Silk Road economic belt, it's just like a sleeping giant waiting to wake up. But if you are afraid of political risk or currency risk, you could invest in a global ETF where it holds stocks all around the world, like VWRD that distributes dividend, or VWRA that accumulates dividend, or Developed Market ETF (SWDA), which holds stocks from developed countries like US, Japan, UK, France, or Emerging Market ETF (EIMI), which holds stocks from developing countries like China, Taiwan, South Korea, India, and so on. Fourth, pick good stocks. There's always one truth. If the company does well over the long term, the stock price will always increase. 2000 to 2013 was a lost decade, right? But Apple has been steadily increasing during that time, going like what lost decade? Same for Amazon. If you invest in good companies, you do not have to be afraid of any lost decade. But what companies are good? There's Tesla, which had 4 profitable quarters already, and is quickly expanding even more. Or maybe Square, which is looking to disrupt how we pay and is quickly scaling up their market share. Or maybe you do not know which companies are good. Then maybe you could invest in a tech ETF like the SSLK. That's because our lives will revolve around tech more and more in the future. Like when we wake up, travel to work, during lunch, all the way until we sleep, everything is tightly linked to tech. Or if you want, you could even invest in Innovative Technology ETF, ARKK, which holds a lot of company stocks that can disrupt the industry, like automation, blockchain, energy storage. Whatever you invest in, as long as it is profitable and is relevant to the future, it will always do well, regardless of whatever market conditions. And that's all for today. Let me know down in the comments below, what do you think? Do you think a lost decade is coming? Like, share, and subscribe, as I'll be posting new videos every Monday. See ya!